And you mentioned too, with like credit scores, it impacts your terms, right? Just as much as the size of the loan.
Absolutely.
Could you dive into that, clarify that a little bit?
The term of the loan, how long we are willing to finance a piece of collateral, could actually be determined by your credit score. So, our higher tiers, a 680 and above, they can take a newer vehicle out to 84 months and take longer to pay off that vehicle, as opposed to someone with a lower credit score. We need them to pay it off a little bit quicker um, because it's a depreciating asset. And so, the people that have proven that they have good payment history, we're allowing them to take this depreciating asset, and at one point it may be uh, they may owe more on it than what it's worth, but we're willing to take that risk because you've proven in the past that you're willing to make your payments. Now, that is just on the term side of it. I mean, interest rate, that's the biggest factor that comes with your credit score. A right now, somebody trying to buy a new vehicle, someone who has an 800 plus credit score, they're going to get, is it low sixes or so in the interest rate?
Yeah,
And
you had written out an illustration for me prior to when we were talking to, and I think your example was a $30,000 loan for 72 months. You said person A who has an 800 plus score will have a monthly payment around 506.
mhm.
Person B has a 620 score will have a monthly payment around 597.
Yeah, so that difference is about $6,000 in interest over the course of the loan. If both
Yeah,
people make all 72 payments, uh, person B is paying much more in interest.
very nice. So, and that's kind of where I think why I wanted to start with the terms. Once you kind of clarify what it takes to get into a loan, right, and then we wrap it up with credit score. That's kind of the foundation of what y'all look at, and in addition to character and collateral, right, the three
Hmm.
C's. I'm listening. I'm
Yeah,
paying attention.
it's good.
And once you have that, then you can kind of step into those worlds of credit card, personal loan, auto loan, mortgage. And it's really important for people to understand how that's a tiered thing. Like if you have a pretty difficult credit score at the very beginning, it's going to be difficult for you to get a credit card. Then if you do get a credit card and you don't handle it well, it's going to be really hard to get an auto loan and personal loan because now you've established character,
Right.
right? And then when you're ready to get a mortgage or if you're trying to get a house, if you haven't handled those first two or three things well, it's going to be really difficult to get a mortgage. Not impossible. You can get it, but it's going to hurt a little bit more because your interest rate might be a little bit higher because of your scores a little bit lower, your character hasn't been proven with payment stability, et cetera, those types of things. Is that a fair assessment? That it's kind of a not a tiered approach. I'm blinking on the word here.
Yeah, no, you're absolutely correct. It takes a lot of time and a lot of effort to keep your credit score up and keep it high. I'd say effort, but it's probably more discipline. Um, but it's very difficult to increase your credit score once you've established some derogatory credit. Credit uh, accounts are reported to your credit for 7 years. So once you have some slow pays, as we call them, on there, where you've been 30, 60, 90 days delinquent on an account, it's very hard to separate yourself from that.
Yeah.
Time heals all wounds, though.
Time heals all wounds. How so?
Well, like I said, it only lasts for 7 years. So I mean, after the 7 years, it's going to fall off, and it's not going to show that you had that derogatory payment.
Gotcha. Okay. Um, so you can improve your score by outlasting the bad stuff.
That's one way.
Can you speed it up by doing good stuff?
Absolutely. One of the biggest things that the credit bureaus are looking at, or what they're using to determine your score, is how you're using your revolving credit.